Grocery prices are about to climb again. Supply of Australian-grown grain, beef, sugar, and fresh produce is tightening. Regional Queensland towns are losing the farms and the small businesses that depend on them. The official forecast just released by Australia's Farm Economics Agency explains why. Average Australian broadacre farm profits are projected to fall 40% in the next 12 months. The decisions farmers are now making, whether to plant, whether to harvest, whether to stay open, flow directly to what households pay at the checkout and what regional economies look like by the end of 2026. The forecast comes from ABARES, the Australian Bureau of Agricultural and Resource Economics and Sciences, in its March 2026 outlook. Average broadacre farm business profit is forecast to fall from $210,000 in 2025 to 26 down to $126,000 in 2026 to 27. That is an $84,000 drop per farm in a single year. Average farm cash costs are climbing from $702,000 to $744,000 and potentially as high as $756,000. When the cost of producing food rises faster than what farmers receive for selling it, supply contracts, fewer crops get planted, fewer cattle get finished, and the supermarket replaces lost domestic supply with more expensive alternatives. Rural Aid CEO John Walters issued a warning in April 2026 that connects directly to what consumers will see. He said the organization is now hearing from farmers who have decided not to sow crops this year. He called it a huge red flag. He said less planting now means less food coming through the system, and that eventually flows through to supermarket shelves. The statement came from the head of one of Australia's largest rural support charities. It was not a forecast. It was a description of decisions already being made on Queensland farms. Fertilizer is the cost driving those decisions. AgForce Grains President Brendan Taylor confirmed urea prices have hit $1,520 per tonne. Reuters reported Australian urea was trading around $1,350 per tonne in early 2026, up roughly 60% since the start of the US-Israel-Iran conflict. Australian diesel prices over the same period are up 88%. Australia imports 64% of its urea from the Middle East Gulf, and disruption to the Strait of Hormuz has cut the main supply route. Australia became dependent on imported urea in 2022, when Dyno Nobel closed its Gibson Island facility, which had a capacity of 499,000 tons per year. There's no domestic buffer to absorb the shock. With urea at those prices, farmers are switching out of nitrogen-hungry crops. Brendan Taylor said growers are walking away from wheat in favor of chickpeas or barley, which require less fertilizer. In southern Queensland, around Dirranbandi, St. George, and Goondiwindi, a winter crop may not be planted at all without more rain. Less wheat planted in Queensland means tighter domestic flour supply, higher bread prices, and increased reliance on imported grain. For regional towns built around grain handling and trucking, less wheat means less work at silos, fewer haulage contracts, and reduced spending at local diesel stops and machinery dealers. AgForce CEO Nikki Ford described what is happening across Queensland in March 2026. She said the organization is hearing from members every day who are struggling to access fuel and fertilizer, facing rationing, delays, and sharply increasing prices. She said this is not a future risk, and it is happening now. AgForce General President Shane McCarthy added that Queensland producers are facing a combination of rising costs, supply pressures, and growing uncertainty. He said agriculture is not operating under normal conditions. The cost squeeze is colliding with two flood disasters that wiped out a year of work for thousands of producers. In late January and February 2025, North Queensland recorded the heaviest rainfall in more than a century in the worst-hit areas. Townsville recorded 1,150 millimeters of rain in the first 15 days of February alone, the wettest February in the city's history. The Herbert sugarcane region was hit hardest. Queensland Cane Agriculture and Renewables, known as QCAR, estimated the Herbert lost between 500,000 and 1 million tons of cane. At an assumed $50 per ton, that translated to economic losses of $25 to $50 million to growers. Wilmar Sugar's Victoria Mill in Ingham was inundated. Banana growers from Tully South reported widespread crop losses. Cane rail infrastructure was damaged, which slowed the 2025 crush before it began. For sugar towns like Ingham, that meant fewer shifts at the mill, less freight on the local rail network, and less money circulating through local businesses for an entire season. The second blow came at the end of the year. Floods began across northwest Queensland on December 24, 2025, and ran into January 2026. The Queensland Department of Primary Industries recorded 48,140 head of livestock missing or dead by January 12, 2026, based on voluntary producer surveys. Officials expected that number to at least double as floodwaters receded. Around 1,973 kilometers of fencing and 3,493 kilometers of private roads were damaged. Properties around Julia Creek and Richmond received more than 500 millimeters of rain. Cattle that survived the floodwaters were then dying from pneumonia and rain scald, the result of standing in mud and water for days. Queensland Minister for Primary Industries Tony Herbert, who toured the affected areas in early January 2026, said producers had invested years into breeding programs only to see livestock perish or need to be euthanized. The economic flow-on runs in two directions. Producers who lost stock face years of rebuilding their breeding herds, which means reduced cattle turnoff from northwest Queensland for the foreseeable future. Tighter Australian cattle supply, at a time when global demand is high, particularly from the United States, where the cattle herd remains at multi-decade lows, supports higher beef prices at retail. For regional towns in the affected zone, fewer cattle on properties means less work for stock agents, transporters, fencing contractors, and the trades that service grazing operations. The 40% profit forecast sits on top of all of this. Queensland's primary industries sector posted a record gross value of production of $26.79 billion in 2024-25, up 18% on the previous year. Cattle farm gate value hit a record $7.88 billion. Horticulture posted its highest recorded value at $4.76 billion. Cotton grew 13%. The sector has never produced more in dollar terms, but profit is what is left after costs, and that is where the squeeze is being felt. Record output is not translating into record returns to growers. The standover cane problem from 2024 illustrates the same equation. Cane growers reported that mill performance failures during that crush cost the industry $179 million. Of that, $115 million fell directly on growers and harvesting contractors. Wilmar Sugar's underperformance alone cost the industry $81 million, with $57 million coming directly from farming families. Around 1 million tons of cane was left in the paddock, with some districts still harvesting into January 2025. That is a year of growing, fertilizing, and irrigating that never reached processing. Cane growers CEO Dan Galligan said the cumulative impact of multiple difficult harvesting seasons is eroding farmer profitability across the cane belt. For sugar communities, that lost cane is lost wages, lost contractor income, and reduced spending across every business in town. Horticulture is facing a parallel squeeze from the demand side. Ausveg's Vegetable Industry Sentiment Survey found 2/3 of growers said they would stop growing vegetables if the right exit strategy arose. Half said they were financially worse off than a year ago. 40% expected to be worse off next year. The Hort Innovation 2025 statistics show Australian horticulture hit a record production value, but growers told the ACCC's Supermarket Inquiry, which delivered its final report in March 2025, that they had not received price increases for up to 15 years. Premier Stephen Miles, while in office, described a Queensland farmer selling watermelons by the road for $10 each because he could not afford to accept the $4 offered by supermarkets. For shoppers, the consequence is a shrinking Australian-grown fresh produce sector, which over time means more imported product on supermarket shelves and less competition to hold prices down. Dairy follows the same pattern. ABARES forecasts gross dairy production value to rise 7% in 2025-26 on higher farmgate milk prices, but the rate of farm exits is now higher than ever according to industry analysis. Operating costs remain high. Input costs tied to global markets are increasingly volatile. A Queensland dairy farmer quoted in industry surveys said having to buy hay is enormously expensive. For consumers, fewer dairy farms means more market concentration, less price competition, and higher exposure to imported dairy products. The flow-on to the broader rural economy is already measurable. ABARES reports Australian farm debt has reached $145 billion, with grain enterprises responsible for almost 40% of that figure. The value of farm loans past their due date hit its highest point in a decade in 2024 to 25. ABARES senior economist Vern Top said part of the increase in new lending last year was driven by higher input prices rather than new investment. Farmers are borrowing more to plant the same crop, which means more interest leaving farm businesses, less capital available for upgrades or expansion, and reduced ability to absorb the next shock. NSW Farmers Vice President Rebecca Reardon said grain machinery capital costs now absorb more than 20% of a grower's gross income, up from 13% 5 years ago. Machinery insurance premiums have jumped at least 25%. Asset values are up 30%. Brokers have indicated there may be only one international underwriter left willing to cover headers in Australia. For regional machinery dealers, that means fewer sales. For contractors, fewer affordable insurance options. For the next generation of farmers, a steeper barrier to entry. The industry is responding within its capacity. The Queensland government, through Sunwater, has awarded the design contract for the proposed Coaranga weir to support irrigators in the Burnett region. A $30 million Queensland Agri-Tech Innovation Fund was announced in early 2026 to move research into on-farm productivity. Exceptional disaster assistance recovery grants of up to $75,000 per primary producer were made available for those impacted by the 2025 North and Far North tropical low, with application deadlines extended to August 14, 2026. A $7 million emergency fodder support package covers 6 local government areas, including Winton Shire. Cane growers launched a task force to address the mill performance crisis. Queensland Farmers Federation CEO Joe Shepherd has pushed for Agri-Tech investment to move from lab to paddock. None of those responses change the underlying equation that input costs are rising faster than farmgate returns. They reduce the financial bleed for affected producers, but they do not close the gap. Queensland farming stands today on a record gross output figure that masks a deepening profitability problem. ABARES forecasts a 40% collapse in average broadacre farm profit over the next 12 months, on top of tens of thousands of cattle lost to floods, around 1 million tons of cane left in the paddock from the 2024 crush, fertilizer at $1,520 a ton, and diesel up close to 90% since the Middle East conflict began. Growers are choosing not to plant crops they would have planted a year ago. 2/3 of vegetable growers want out of the industry, and Australian farm debt sits at $145 billion. The Bureau of Meteorology's 3-month outlook to August 2026 indicates below-average rainfall is likely for central and southern Queensland, with above-average maximum temperatures. The conditions squeezing margins are forecast to continue. For households, that means continued upward pressure on fresh food, meat, and grocery prices. For regional towns, fewer farms, fewer contractors, and fewer dollars moving through Main Street businesses. For the supply chain, less Australian-grown product flowing through it. The pressure has not eased, and the people growing the food are absorbing it first. If you found this report useful, subscribe to stay across what is happening in Australian agriculture. We will keep reporting.